Hello, I'm Gabby Partington and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Today we're going to be looking at two investment styles, value and growth, and ask, is it time to consider a switch out of growth and into value? This debate has been running for some time now and in some ways has come to define market performance over the last few years. Until recently, growth has won the argument hands down. The performance of the tech sector has been so strong and value stocks that are based in the old economy have performed so poorly that it's been one-way traffic. However, many of the world's economies are now in a technical, if not full-blown, recession and stock markets are being driven by stimulus measures. As a result, institutional investors are looking to the future to see what comes next in attempts to determine the pace and shape of the recovery from COVID-19. Recent research from Goldman Sachs showed that mutual funds are surprisingly underweight on the leading lights of the growth factor, the so-called FAAMG stocks. That's the quintet of Facebook, Apple, Amazon, Microsoft and Google. Being underweight on these stocks is a decision that has likely been forced onto the fund managers simply because these names have grown so much that they account for some 23% of the S&P 500 by market cap and around 37% of the Russell 1000 index in capitalisation terms. The rules that govern mutual funds mean that managers would be in breach of position and exposure limits if they were even at market weight, let alone the overweight, on these stocks within their funds. In layman's terms, this means that these growth stocks have been so successful that fund managers are restricted by their own rules and regulations from investing into them further. Goldman's examined 572 equity mutual funds managing $2.41 trillion and found that on average they were underweight on FAAMG stocks by just over 5%. The dominance and sheer scale of these mega cap stocks are causing a real headache for fund managers. The picture is far more straightforward in the world of value stocks, with no single stock accounting for more than 3% of the Russell 1000 value index. In the same study, Goldman's found that in the list of top 10 overweight stocks among mutual fund managers, there were several classic value plays including Citigroup and Bank of America. Legendary long-term value investor Warren Buffett topped up on Bank of America in early August, pumping $2.1 billion into the stock to take his holding to 12% of the company. Here we have quite a quandary. Because growth stocks have performed so well for so long, the assumption is that the recent sell-off might indicate a rotation to value stocks. However, when we look at mutual fund holdings, some of the biggest investors in the market, we find that they are underweight in growth stocks and overweight in value. Looking at Trackstar ETF data, we can see that growth equities are still popular with both institutional investors and retail traders. However, institutional investors are now starting to research value funds in high dividend yield stock ETFs, which are synonymous with value investing. Understanding inflation plays an important role in figuring out the pace of this rotation. A rise in inflation would be a catalyst for rising real asset prices, real assets that typically reside in value stocks and trade at a discount to their underlying net worth. Morgan Stanley has taken the view that inflation is ballooning quickly thanks to a steeper side V-shaped recovery. However, JP Morgan believes that inflation will remain scarce as long as the wage growth remains subdued and the labour market lacklustre. What we do know is that there isn't a consensus view and the masters of the universe are undecided on what comes next. In recent weeks, we've seen big sell-offs in growth stocks stemming from the tech sector. This may or may not be led by the unmasking of SoftBank as the Nasdaq well, but as our proprietary Trackstar data suggests, the growth run is not over just yet. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions.